Well, let's get started. I've got a few new charts that I would like to work or present today regarding the gold mining industry. I do think that's the most important thing to be discussing right now, and in terms of things that are timely, things that are urgent, things that are changing fundamentally, but also from a macro standpoint, we continue to have what I would say is the box are checking when it comes to the changes of the underlying commodity that is linked to these businesses, which is gold. But we're also seeing a strength across other metals as well. Silver, not today, but copper certainly is in a very significant breakout today, specifically this week. One of the biggest moves on a weekly basis that we've seen in a very long time. And it begs the question because a lot of folks have lost faith on the capability of mining companies to actually make money. And what I'm seeing across the board of a few of metrics that tend to actually show the level of profitability improvement or improving of most of these companies is to me extremely important. So in this case, you're looking at the cash flow. So we're doing the aggregate calculation of the gold miners. We're looking at the Philadelphia Stock Exchange Gold and Silver Index, of which we're seeing at a cash flow per share basis, the highest level of this metric in 13 years. Now, we've had I think the biggest issue regarding the lagging of gold miners has been, in fact, the situation regarding earnings, of which have remained substantially lower than what they were back in 2011 periods and so forth. Now, what is important to see is this change that we're currently experiencing as metal prices continue to firm up at much higher levels. These companies are starting to actually make money. This reminds me of the energy space, when people used to say that energy companies would never make money, and eventually they started actually printing money. You started to really generate cash flows to levels we didn't see in many decades. And so I think that the same will happen with the mining industry, and we are essentially in the process of seeing that. When I go to the next chart, looking at the top line, more on a quarter-over-quarter basis, we did see the best quarterly growth of the mining industry when it comes to revenue per share in 15 years. Now, this is important as well. It's obviously related to gold prices improving, but as I just showed in the chart, in the prior chart, the bottom line of these companies is also improving. From a free cash flow standpoint, free cash flow, especially relative to enterprise value, a lot of these stocks are also trading at historically cheap multiples, which is something to be aware of as well. So basically, what's happening is, we are seeing substantial improvement when it comes to the fundamentals of these companies. And I still think that, it's probably, especially for 2025, if not the best industry that is poised to do very well, in my view. But also, it's also very related to our macro views when it comes to what we think gold will do, of which I'm going to touch on very soon. But if you go back and look at a price relative to net asset value of the mining industry, and this chart goes all the way to 2024, you can see that the gold equities, just to put into perspective the valuation, side of things regarding, especially, how early we are potentially into an upward trend or a bull market for this overall industry. You can see clearly that, one of the things that sort of helps to identify those early stages of a bull market, it's not the only one, it's not the main one, but it's an important one, is certainly the valuation proposition, of which, when you're looking at the price relative to net asset value of the mining industry, we're at one of the lowest or the cheapest levels in 40 years. And so I understand we've been talking about these things for some time now. We even launched an entire fund focused on deploying capital into this space. But I can't think of a better time to be, not only an investor in this industry, but also, being deeply involved in many fronts, and being able to understand this industry, which is so niche, better than other folks out there in terms of market participants. And so I think this is an incredible setup from a macro perspective, but also from a value as well. And one thing I noticed the other day that is important is this fear of missing out of most of the governments. The FOMO is real. A lot of governments are starting to accumulate gold to a magnitude, or I should say, to a degree that we haven't seen in many decades, depending on the country. In this case, you're looking at India, one of the countries that we are very much aware of how much India has been, had a history of its influence in gold and silver and monetary metals in general, particularly their cultural views about the metal itself. And so it's important to see a country like that actually stepping in and purchasing gold as much as it has been more recently. This is a 6-month change in gold imports, and clearly we haven't seen anything like this for over a decade. And so certainly there has been a level of accumulation of the metal across other central banks as well, not just India, that I think it's been very relevant too. I wanted to update this chart because I do think it's a chart that kind of creates a roadmap for where we are and potentially how early we still are in this. And again, our views are that we are in the early innings of a bull market for gold. And what we're seeing in terms of the prior cycles and the list that I put in this chart in terms of what I thought was really the fundamental reasons of why gold was rallying during those periods. 1970s, we had an inflationary era. We did see central banks accumulating gold. Quentin can probably talk a lot about the issues regarding new discoveries of that era, of which after gold prices went up so much, we went through a period of some of the best discoveries that happened in the 1980s and 1990s. But before that, we did see a period of almost no discoveries. And actually, gold production was falling in the 1970s. In the early 2000s, we did see something similar. Production was also falling. But it wasn't so much of an inflationary era. We didn't see central banks buying gold at all, actually. There were sellers of gold at that time. But China was entering the WTO, and it became the biggest and the largest driver of commodities as they were in their building period. And gold, as also should point out, was extremely cheap relative to the equity markets, which is certainly the case today as well. In terms of today, we do see production falling for gold, which was the case with the prior cycles. We are seeing central banks accumulating gold to a degree that we haven't seen since the 1970s. The issue that Kevin was referring to regarding deficits and government debt is certainly something we didn't see in the 70s. That is a big driver for gold today. But instead of seeing China, we're actually seeing large G7 economies and other economies actually starting to do something that I think is likely to be even more relevant than what we saw with China, which is the onshoring happening globally. Basically, countries looking inwards and starting to redevelop their industrialization or industrial capacity and manufacturing capacities. It's something that is also starting to have an impact in things like copper and other metals that have been rallying given these changes in policies across the globe. nonetheless, I think there's all sorts of things that are drivers in this environment. And one of them that I think was also, that I should point out, that was also something we saw in prior bull markets, was the ultra conservatism by most mining companies. That more recently, I think those that factor specifically has been been ignored. But despite the M&A, of some of the M&A that we've seen in this industry recently, we're still not seeing the capex growth that we would normally see with gold prices where they are, which is a big sign for how, in my view, early we are still in this cycle. So it wouldn't shock me to see prices substantially higher by the end of this decade. And to me, that's the most important thing to pay attention to, because if that's the case, then the mining industry is grossly mispriced, in my opinion. So one metal that tends to follow another metal is gold. Tends to have a very strong relationship with copper, despite copper having such a much larger cyclicality. And this chart was from a couple of days ago. It's already old, because copper is actually already on this catch up with gold prices. It's breaking out today, as I mentioned earlier. It is probably one of the most important movements happening this week, in my view. When Kevin was talking about inflation and other issues, and metals are one of the most important things when it comes to signaling inflation ahead, and copper is not being shy. It is certainly having a movement with authority, of which I still think copper is incredibly undervalued in many fronts, particularly relative to gold as well, which is it's something to be aware of as well. Now, when we looked at breakouts and technical setups that we think are important, gold adjusted for money supply is something that I think is almost on the verge of what I view as one of the most important breakouts for the metal that we're likely to see. When gold is adjusted for money supply, we're extremely we're approaching what I think it's likely to be a major breakout for the metal. It's important to look at gold relative to money supply, because it also puts into perspective how much we've had in terms of creation of money or fiat currencies overall. In this case, you're just looking at the U.S., but which is more relevant for the dollar specifically. But you can also do the same with global money supply, or for those that like to look at money supply of other countries. What you're going to find is that we're still at historically cheap levels, but most importantly, what I think it's approaching an inflection point that could be accelerating to the upside as we break this support that has been really a historical support of over 45 years, 50 years almost, of that we've been bumping into and not breaking out. And I do think this is a special moment in history that we're about to see a very significant breakout that will ignite what I view to be the beginning of a bull market. I can't say the same about NASDAQ. NASDAQ is in a very bubbly territory. If you're just looking at one metric, which is, again, not the only metric should be looking at, there's other valuation factors that one should be considering. But NASDAQ 100 is extremely expensive on a money supply basis. And it is interesting when I see markets declining and people saying, especially during the DeepSeek sell-off moment a few weeks or a week ago, some folks were saying how markets were oversold, and immediately what comes to my mind is a chart that looks like this does not mean NASDAQ is oversold at all. In fact, one sec. I think we're on the other side of this. I think we're in a much more speculative environment than hard assets like gold itself. Kevin was talking about a little bit about the tech space, and I think one thing I noticed at least that has been happening more recently has been a rotation in markets. We are experiencing a large rotation. Technology is the only sector down year to date, and all the other sectors are up. But not only that, but there's a few sectors that are up substantially already. So there has been smart money is rotating to other places, and some of them are in a natural resource space, but also in other industries like industrials, even consumer discretionary has been doing well. Healthcare has been doing very well. But clearly there has been a rotation out of technology. But this rotation, in my view, although it's at a very early stages, I think there's a lot more to happen here, and what I call the rebalancing. I think there's some major rebalancing ahead of us, not only in across sectors, but also across countries. Looking at the U.S., the U.S. companies and this, this period of American exceptionalism that I don't think we've ever seen in the past to the degree that we're seeing today. I think that we're going to see some rebalancing out of those of the U.S. and into other parts of the world that will likely benefit tremendously from today's macro setting. Inflation is something that has been on the rise, as I think Kevin mentioned. We're at a near 2-year highs on the 5-year inflation expectation, of which is really CPI expectation by the market, which is calculated by the 5-year break even in this case. But across all durations of the break-even rates, markets have been pricing higher expectations for CPI, of which is inflationary. And not only that, I was talking about also the copper, and some of the metals that have been moving higher in line with these expectations on having an upward movement. Now, I think there has been some important also remarks from Basson more recently, 2 interviews in particular that he had, one with Fox Business and the other one with Bloomberg, that I think there was a lot of takeaways from that. One of them, in my view, I think there's been a lot of focus on the 10-year yield. Although he mentioned very clearly that they want the entire curve to be lower, the entire curve to be, significantly lower. The other thing that I thought was interesting, of which I've shared some of my views on this, is the dollar. He broke down the dollar, the strength of the dollar, in 4 categories. I wrote it down. One of them is credibility, which is through the rule of law. The second one is as a composite, which is the price in the screen, the DXY index. The third one is the bilateral price that he calls, of which he made a comment on the Bloomberg interview that I think it's incredibly important. He said that he doesn't want other countries to weaken their currency to manipulate trade. And number 4, he talked about creating the best policies to create also a strong dollar. Notice he's not talking about strong dollar on a DXY basis, in my view. What he's talking about is the strength of the dollar in regards to the reserve currency status, of which he mentioned again that the fact of keeping that reserve currency status, but also letting the dollar fluctuate are both not mutually exclusive. He did say this in the Fox Business interview, right around 11-minute mark. If you listen to it carefully, you're gonna hear what he said exactly on that front. I do think that's an important aspect, because I do think that the dollar is going to be one of the things that are going to be impacted. Now, if you have the entire curve lower in terms of yields, and at the same time you have a dollar that is not supposed to be rallying so strongly, what does that formula mean? That means that the 2 biggest risks for investing in emerging markets are taken away. They're not in place anymore, most likely. So what does that mean for emerging markets? I think it's a green light. I've been talking about it from a valuation standpoint and rotation, but also even allocation of capital that has been so neglected. Reflecting on the valuation, I think emerging markets are getting a green light on all this, and so for a lot of other reasons too. But even from a policy standpoint, by the Treasury Secretary, I think that's an important change in this whole part of the market.